Hello and welcome to the CIMA and Innervision Live webinar on how to plan for IFRS 16 ASC 842. My name is Chris Hooper and I'm the Senior Editor of Financial Management Magazine, which is produced on behalf of CIMA. We're delighted to have so many of you joining us today for what promises to be a fascinating discussion about the new lease accounting standards, the deadline for which is fast approaching at a rate of knots. We have two special guests joining us today, Martin Kennard and Maeve O'Connell. They both work for a company called Innervision, who are a leasing consultancy and specialist leased service supplier that has been providing lease accounting solutions and portfolio management services to a global corporate lessees since 1992. Innervision's lease accounting solution, which is called LOIS, is a flexible web-based application that supports both current IAS 17 lease accounting standards as well as the new IFRS 16 and ASC 842. LOIS caters for all lease types, including equipment and property. Now, Martin Kennard is a director of Innervision. Since joining the company in 2006, Martin's leadership and strategic decision-making have been instrumental in driving the significant growth of its lease accounting, of its lease management services and of the Innervision brand. Martin has extensive experience of advising large corporate clients in both the UK and internationally on a broad range of leasing-related activities, including the preparation requirement for the new lease accounting standards. As Director of Innervision, Martin manages overall strategy, supports the major accounts and plays a pivotal role in pursuing new business. Having held various leadership positions during his 25+ years with the leasing and asset finance industry, Martin has acquired a deep practical knowledge of the challenges of large corporate lessees. Our second guest, Maeve, is Commercial and Finance Director at Innervision. Maeve joined Innervision in May 2016, taking the design lead of LOIS Lead Accounting Solutions. Maeve is an ACMA who has worked in the leasing industry for more than 13 years and was previously in banking and private healthcare. Maeve's prior experience as a financial controller has helped provide a practical application of the IFRS 16 and FASB ASC 842 standards in the LOIS lease accounting solutions. Thank you to you both for joining us. Now, we're going to spend the next 30 minutes or so chatting to Martin and Maeve about the challenges presented by IFRS 16. We are going to cover what the general changes to the lease accounting rules are, how businesses can assess the extent to which they will be affected, and the steps those in finance departments can take to make the transition to these new standards as seamless as possible. After that, there will be an opportunity to put some of your questions to Martin and Maeve directly. Submitting a question is very easy. Simply go to the webinar control panel in the corner of your screen and select the questions drop-down menu. You can type your questions into the box there and click send. We will try to get onto as many as we can in the time allowed today, but if we don't have time to cover all of your questions during the Q&A, someone from the team at Innervision will follow up with a response to every question via email after the webinar is finished. So please do submit your questions as they occur to you. Now, before we begin, just run a few more minor housekeeping rules. First of all, to minimize disruption, you have all been automatically muted. So if you want to chat to your colleagues or eat your lunch while listening, you can do so without fear of it being broadcast. Also, you will receive a copy of the recording of the webinar after this session is finished, so if there is anything you want to hear again, you'll have the chance to do so. Okay, let's get started. The new regulatory lease accounting standards, ASC 842 and IFRS 16, are created by the US-based Financial Accounting Standards Board, the FASB, and the London-based International Accounting Standards Board, the IASB. The key objective of these revised standards is to enhance financial transparency by having the liabilities that asset and property leases incur represented on the balance sheet. Of course, this is a drastic change to the way leases are treated in accounting, and this could have a dramatic impact on how businesses or organizations define its financial metrics, how it organizes and understands its business model, and how a business understands, organizes, and uses its data and processes. Obviously, the impact of organizations will depend on, so the impact on organizations will depend on the sector and geographical location they operate in. But it's worth noting that the deadline for these changes is fast approaching. The new IFRS 16 ASC 842 lease accounting rules are generally effective from January the 1st, 2019. So I think without further ado and wasting any more time, let's bring in our first our guests. Martin, let's start with you. I guess the best place to start. What are the main accounting changes under the new lease accounting standards?
Yeah, thanks, Chris. So, I mean, there's two principal changes under the new standards. Firstly, the definition of what is and what isn't a lease has changed, with much greater emphasis now on control and use of assets. And this is particularly relevant for certain service type agreements where there is an embedded use of an asset within that agreement. But by far and away the biggest changes of the new standards, and the one that we're going to be focused on today, is that the vast majority of leases will move on balance sheet. So the current differentiation between an operating lease and a finance lease effectively disappears as far as lessees are concerned. The objective, as Chris mentioned earlier, is to improve the transparency of financial reporting, but the effect of these changes is really quite dramatic. There are a few exemptions, so there's a couple of specific exemptions mentioned in the standards. Firstly, for low-value items, and secondly, for short-term leases. Low-value items are sort of deemed to be individual assets which have a value of less than $5,000. So individual assets that have an individual value of less than $5,000. So, for example, PCs and laptops could fall under that exempt status. And even if you're buying or leasing 10,000 or 50,000 of them under a single lease schedule, you could still potentially take advantage of that exemption because individually they have a low value. The second exemption is for short-term leases, and short-term leases in this context are defined as being less than 12 months. Any lease in existence at the time of the adoption or any new lease that they're entering into which is less than 12 months could potentially come under the exempt status. We're already seeing a few lessors reacting to these changes in advance, and some in the IT sector in particular looking at whether they can have a sort of succession of rolling 12-month leases to try and to get round and gain that exempt status. Whether that actually works is clearly down to the lessees and auditors as to whether that's just a way around the standards or whether that's a practical exemption that can be taken. But despite the exemptions, there is a huge impact from the changes. The Wall Street Journal estimated that something like $2.8 trillion of assets will come on balance sheet globally. The vast majority of that by value is going to be on property, because property is the standard method for funding property is currently by using operating leases, but the vast majority by volume is likely to be in other sectors, so things like cars, IT, plant and machinery, other vehicles, that sort of thing. So a huge impact, and the effect being a much larger balance sheet. And I'm just going to hand over quickly to Maeve, who will explain in a bit more detail the effect, the financial effect of that larger balance sheet.
Yes, so the lessor accounting is largely unchanged. The lessee accounting, however, as Martin is saying, is changing quite a bit. So you will be bringing your existing operating leases onto the balance sheet, and as a result then your leased assets will increase, your financial liabilities will increase, and as a result your equity will reduce. And the reason for that is the carrying amount of the leased assets typically run off quicker than the carrying amount of the lease liabilities, and that's because you are depreciating the leased assets on a straight line basis, and obviously the liabilities, you have the interest release higher at the start of a lease and lower at the back end of a lease, so a different kind of runoff for both the right of use asset and the lease liability. As a result of putting your operating leases onto the balance sheet from a lessee perspective, you will end up with a higher asset base, which then in turn will impact any ratios relating to your assets, such as your asset turnover. You'll have higher financial liabilities, and these will affect things like your gearing, and then your income statement and your cash flow statement are also impacted. You will have a decrease in your operating expenses and your cash outflows because you have no operating lease expense, and instead you'll have depreciation on all leased assets. You will also increase your financing costs and your cash outflows because, again, you have interest on all of your lease liabilities. Now, your EBITDA will change, and the reason for that is you will now be moving away from your single expense that you recognize for operating leases under your operating costs at the moment, and you will be moving towards the same sort of recognition as you see with your finance leases. So you will actually be seeing an increase in your depreciation, which is obviously below the line from an EBITDA perspective, and an increase in your financing costs. And as a result of that, you would expect to see that lots of KPIs impacted by which are related to EBITDA will be impacted. So that may affect your banking covenants or your funder covenants. So from an IASB perspective, they don't actually define what EBITDA is. So you may have to just re-engage with your funders and actually go through the changes of the IFRS 16 accounting changes. It might mean that you have to work with the existing definitions and rework your numbers based on what the pre-IFRS 16 EBITDA would have looked like. So it's worth engaging early with your investors and your funders. Other KPIs that would be impacted would be your employee bonuses, again, if they're based on EBITDA, and so too with share prices. So thank you. I'll just hand back now.
Thanks very much. I mean, it sounds like it's it's a quite a monumental task actually, and what we're discovering from some of the interviews we've done for the magazine and things like that many companies have sort of yet to start this this sort of lease accounting project, and it's as you say, it's quite a big task. I think it's worth reiterating. We touched on it in the intro, but when is the implementation deadline for these new standards set to take place?
Yeah, so the accounting standards finally announced their decision after many, many years of deliberation in January 2016. And I've, as you mentioned earlier, I've been in the leasing business for well over 25 years, and everyone's been talking about getting operating leases on balance sheet for pretty much the entire period that I've been involved in leasing. They finally got round to that announcement in January 2016. The implementation deadline is 1st January 2019 for all December year-end companies. And whilst originally the 3-year time frame seemed like a reasonable period for people to get familiar and up to speed and get their project kicked off, we're now 13 months to go and the deadline's fast approaching, and a lot of companies are really at the very early stages of the process. There is later adoption for smaller non-IFRS companies and for the public sector organisations, and in theory at least there's an opportunity for early adoption, although clearly you're leaving it a bit late in the day to early adopt now, and principally that's aimed to try and sort of tie up the IFRS 15, the revenue rec, and the IFRS 16 projects together, but we're seeing very, very few people taking advantage of that early adoption. Yeah, so that's the deadlines we're working to.
Right, and so what are some of the sort of main implementation challenges then that businesses are faced with?
Yeah, I think the first thing to say is that most companies are finding the IFRS 16 implementation challenges significantly harder and more time consuming than they first imagined. There's a whole pile of interlinking parts to the project, but it really starts with the basic question is what leases have I got? And this isn't just a question of identifying asset classes and lease categories, but it's also assessing whether an agreement is a lease agreement or for example, a services agreement. So the first challenge, identifying asset classes, it's relatively easy to work out that you've got a bunch of property or a fleet of cars, and those are relatively obvious leases to find. Much more difficult is to find the portfolios of the other bits in the middle, the sort of IT equipment, the office equipment, forklift trucks, plant and machinery. There's a whole pile of potential leased assets that you might have in your organisation which you won't necessarily have any centralised control or information on. But once you've identified the categories, there's also then various assessments and judgments that you need to make, typically between lessees and auditors. These are the sort of things that you'd be discussing. Basic things which appear on the surface to be very simple, so like what is the length of the lease? There is a phrase in the standards, reasonable certainty, and if you have a lease with a break option or if you have a lease with a predetermined extension option, then you need to assess the reasonable certainty of exercising that option, and that will dictate your right of use asset value, so it will dictate the value of the lease and the term of that lease. Another area that's been causing a lot of interest and a lot of debate is IBRs, the interest rates that you should use for the calculation of the right of use asset value. And whilst it's quite easy to work out what current interest rates are, it's much more difficult to look historically back to find out historically what interest rates were, and the differences can have a significant impact. Also, there are a number of different transition options, and they make a very real difference to the balance sheet and to the application. So I'm going to hand back to Maeve now, who will just describe in a bit more detail the different transition options available.
Okay, thanks, Martin. So as Martin was referring to earlier, you have to start accounting for for IFRS 16 for annual reporting periods beginning on or after the 1st of January 2019. Now, early adoption is permitted for entities that apply IFRS 15, but I would imagine it's a bit late in the day to be doing early adoption at this stage now. You've got two transition options available to you. You have the fully retrospective approach, and you have the retrospective with the cumulative effect, or the modified or partially retrospective approaches. The fully retrospective approach means that you actually have to have all of your historical information. So you would record your lease from inception of the lease using the rates in play at inception of the lease. Then you have to overlay all of the in-life changes that have happened, all of the rent reviews, extensions, you name it, that have happened to that lease. So there's an awful lot of information that needs to be collated. You have to apply, if you go for the fully retrospective approach, it is an all or nothing. It has to be applied to every single lease you have. So a lot of our clients might have started off with the intention of going fully retrospective, have got the information on their high value leases, only to discover that they don't have the information on their low value leases, in which case it wasn't an option for them. The modified or partially retrospective approach looks at from your transition point forward and looks at the future rentals at that point, calculates the PV of those rentals. That becomes your lease liability, which is also your right of use asset starting position. Unlike the fully retrospective approach at the point of transition, because you've gone for the historical information, your right of use asset could be very different because it's depreciated on a straight line basis from inception of the lease up to the point of transition. It could be very different to your lease liability, which is based on the future rentals. The alternative that you have to the modified retrospective is to actually go for the modified retrospective approach, where you take the lease at inception of the lease and actually calculate what that historical right of use asset balance would be at the point of transition. So you would take all of your information from the start of the lease, work out what your net book value is of your right of use asset at the point of transition, and still have your lease liability based on the future rentals from the point of transition. That would give you a bit of a mismatch, and the difference obviously is taken to equity. With both approaches, it is best to have as much of this information available to hand in order to make the best decisions for you. We do advise our clients to gather as much historical information as possible, so that that gives them the greater choice in which transition option to go for, because it can have a significant effect in your results. If you go for the historical right of use under the modified approach, you might find that you have a hit to your equity at point of transition, but a lower depreciation charge going forward. It really does depend on the life cycle of your leases. So I could talk about this forever, but I'll hand back to Martin.
Yeah, thanks, Maeve. So there are a number of different assessments, as you heard, and a number of different transition options to look at, but there is a real basic requirement here, which is gathering data, gathering and validating data. And leasing tends to be, especially operating leasing, tends to be a very decentralized function within organizations, both in terms of geography, divisions, whatever. Data's held in multiple different formats, sometimes with no records. If you're lucky, you've got an asset management system. The vast majority is held on spreadsheets or hard copy invoices, or sometimes in filing cabinets. And you've got the added complication, if you're an international lessee, of language issues as well. Lease documentation is complex. Anyone who's looked at a property lease will know that they can be 40, 50, sometimes longer pages long. They're not in a consistent format, and extracting the data from just one lease can be very time consuming, and certainly is an expert task. We also have another example from an auditor where they looked at one individual IT lease and claimed that it took them 3 hours just to extract the relevant data from one lease document. We can also, from our experience, guarantee that whatever the source of the data you've you've got, it won't be sufficient to complete the task. We have 25 years experience of managing lease portfolios, and all of the data is never available at the first instance. So finding the data is a really important task. One example I always give is of one of our UK clients. When we took over their portfolio, they told us they had 400 leases. By the time we'd finished the task, they had well over 1,800 leases. It's just an area that hasn't received that centralized focus and attention in the past. You've heard about the transition options. Some of the more favorable ones involve gathering historic data. That's even more difficult to find. We have a client who has a portfolio of property leases of something like 2,000, and in the gathering of the data, they discovered they had well over 20,000 price changes to take account of in that 2,000 lease historical portfolio, all of which need to be gathered if you're going to try and embark on the historical transition option. We also have another customer, by the way, who has its first lease started in the 1800s, and obviously going back to the 1800s does require quite a lot of effort. The next challenge I think most people face is identifying a suitable system to help manage with the transition to the new standards. It is almost universally accepted, I think, now that spreadsheets are not sufficient, not robust enough to cope with portfolios of leases of any size. I don't know what the size is, but we sort of think anything from 50 plus means that you should be looking at a system. There is only 13 months to go for most organisations now between the date of adoption and today, and that means you haven't got time to go through a long drawn-out procurement cycle followed by a long drawn-out implementation project. So it's very important, I think, to look at easy to install, easy to implement systems. Otherwise, you're just going to run out of time. And also impact modelling. As soon as you get your system in, what we're encouraging our clients to do is to say, right, load up those leases, look at the various transition options, and try and model which is best for you. But obviously, if you don't have a system, that process becomes a lot more difficult. IBRs make a big difference as well. So, modeling different IBRs will give you very significant differences. We had one lease we looked at for a client a couple of weeks ago, and changing the IBR by 1% made something like a £2 million difference to the right of use asset value. It's obviously quite a big lease. And finally, for me, one of the other big challenges is, it's all very well getting the system together, getting the data in the right order and with the right information, putting it in nice and neat and tidy and producing the right reports. But there's absolutely no point if you don't have a process to ensure that that data is maintained and the accuracy of that's maintained. So it's really important, as a final point really, is to say that designing processes is a really important part of this process. Thanks, Chris.
I think that's very interesting. Actually, I think we've obviously covered some of the challenges there. I mean, it's the two examples you gave, for example, going back to the 1800s or the thousands and thousands of price changes. But do you think that coming at this question from the other way, do you foresee any opportunities for companies when transitioning to IFRS 16 or ASC 842 where they could possibly benefit from this?
Yeah, I mean, I think that's exactly right. Most people start off viewing this as a compliance pain. I noticed the CFO of HSBC describing the IFRS standards as being a monumental pain in the arse, and that's definitely the starting point for most organisations. But I think if you adopt the right approach and set up the right sort of project, then there are significant benefits you can gain from it. The processes we've talked about, you will need to define and centralise and standardise probably those processes, at least processes a lot more. At the moment it's not unusual to find a warehouse manager ordering forklift trucks and organising the leasing for the forklift trucks, and he might be very good at specifying the configuration for the truck, but he's almost certainly not very good at designing the terms and conditions and the lease rates for his leasing of that truck. So centralising, standardising, bringing expertise into that process is bound to help. We've talked about data and systems gaps. There will inevitably be big gaps. They will be filled. Hopefully you will have a new system, and you will certainly have to gather a lot more data. And once you get to having a good visibility of your portfolio, then you can start to do things like what we would call the term proactive lease management. So that's actually making decisions you want to make about the assets that you lease rather than reacting to what you have to do under the terms of the lease, and that should enable you to drive out portfolio savings and savings from those leases. And again, an example that we have One of our clients, when we took over the portfolio, had written a 5-year lease on a vehicle. When we took over the portfolio, that lease was just entering its 15th year. They were still paying the full rental on the vehicle, and in fact, they'd actually sold it 5 years before. So obviously, if you start to get that type of information out of your portfolio, it won't be too difficult to spot opportunities. So improving portfolio efficiency, I think, is a really nice spin-off benefit from this, and that's a combination of, as I say, reduced pricing to lessors, but also increased efficiency and reduced resource internally. So I do think there are some significant benefits if you get this right.
In your sort of experience in the field then in this industry, I mean, how many sort of companies have started the implementation process, would you say?
Yeah, we speak to many lessees around UK, Europe and beyond, and we've attended and sponsored numerous industry events and conferences, and it still surprises us, I think, how slow in the implementation, or how early in the implementation process people are. You know, we sponsored an event, an IASB event in Amsterdam last month, and these were the slides you can see here are the results that we polled from the audience there. So as you can see, top left-hand side, 4% people have finished, which is not very many, and the vast majority, 60–75%, are still in the data collection and identify systems phase. So we are surprised by how early in the project most people are. Just at the bottom left of the screen there, you can see that 53% of the people, their lease data is all over the place. We actually, from our experience, would consider that a low number. We think that 53 should be closer to 70 or 80%. So yeah, I think the answer to the question is that most organisations are very early in the process, and we're starting to get concerned that time is running short.
Absolutely, and I think so. Well, following on from that, I suppose, and what would be the dangers of delaying?
Yeah, I mean, I think people, as we've said, are finding the project a lot more complex and a lot more time-consuming than they'd hoped for at the very beginning, and trying to bind in the organisation and the different functions and the different divisions into the project is proving to be quite a task for most organisations. But the reality is, the longer you delay this, the less options you have, and particularly we go back to those transition options. There are some significant benefits in analysing the correct transition option for you, and pursuing that route. If you run out of time or you don't have sufficient data, then you're going to be forced down the easy option, the modified option, and that may or may not be your best option. So I think that one of the first dangers of delaying is that you narrow your options. You can't necessarily take advantage of what you ideally would want to do. Second thing is that I think you're going to find that auditors and suppliers generally are going to be really overrun with business and implementations as you approach the deadlines. Now, I guess I would say that, wouldn't I? Because as a supplier, we're very keen to promote our services and get people buying as quickly as we can. But we are extremely busy already, and we envisage 2018 being even busier. We know from anecdotal evidence that the auditors are already stretched with resource. Clearly, they have a lot of people around, but we do know that one large lessee had a project team of over 60 from one of the big four auditors, just collecting and validating data. So it won't take too many lessees before even the auditors get very stretched for resource. And the third thing from my point of view is the implementation of the system. Its time is getting short. Systems need to be implemented very quickly to enable the compliance, and some of the fully integrated ERP solutions from the big vendors are very complex and take many months to implement. So I think getting to a simple, easy to implement solution is a key part of the project going forward. There's also some other elements that finance teams I think are working or preparing for, and I'll hand over to Maeve just to explain a bit about that.
Yeah. So our existing clients at the moment are primarily concerned with that engagement with their stakeholders, and the first thing they do, other than trying to get all of their information on the system, is to use the system to actually model what their operating lease commitment note will look like in the next financial year. The reason for that is you don't obviously want to have a great reconciliation to have to explain when you do adopt IFRS 16 between what your old up lease commitment note was versus what you've now taken on balance sheet. So people are focusing on that, a lot of effort in getting their op lease right now, so that you don't have to explain any great differences in under IFRS 16. The other thing they're also doing is they're looking at what the impact would be, so that they can answer their IAS 8 note, so the impact of IFRS 16 adoption. So they're doing that for two reasons: obviously to be prepared for the transition from their own financial statements perspective, but also to engage with their stakeholders, including their investors, discussing with their debt covenant providers, etc. So there's quite a lot of work to do, and the more time you give yourself to do that, the better prepared you are, and you're not caught out at the last minute. So thank you for that, Chris.
Hello, sorry, slight technical problem there. Yes, I think we've sort of covered some of the solutions there, I think, but it's probably worth taking a slight step back and just sort of examining what a typical lease portfolio sort of currently looks like, if that's okay.
Yeah, and again, we've got 25 years of managing lease portfolios, so we have a pretty good idea what the typical one looks like, I think. And most portfolios, as we said, are decentralized and largely unmanaged, with local divisions and local departments given a lot of autonomy over how they manage and organize their leases. So there's little consistency and standardization in terms and conditions, in rates, or even in lessors. Data is held all over the place, as we've talked about already, from filing cabinets through to spreadsheets and PDFs. If you're lucky, there might be one or two asset management systems, particularly around property and fleet, which tends to be the area that is relatively well known, but almost exclusively the rest is held in spreadsheets in different locations. And this lack of visibility and centralized control is really one of the major complexities and issues to do with the compliance of the new standard. So that's a very real practical challenge. Back to you, Chris.
And given the given the sort of sometimes scattered nature of this sort of data, I suppose, then what should companies be looking for in their sort of lease accounting software solutions?
Well, obviously the first thing to do is to make sure that the system performs all of the necessary calculations that you need to comply with the new IFRS 16 standards. The actual the initial lease calculations, the initial lease accounting calculations are relatively straightforward. The complexities around the standard really all centre around the modifications, near knife changes, things that happen within the lease during the term of that lease. So early terminations, extensions, price consideration changes, those sort of things all have a particular impact under the standards, which needs to be calculated within the system. It should also obviously act as a repository, central repository for lease information. Part of this process, as we've said before, should be about centralizing and standardizing the data. And beyond that, the system needs to be easy to use, because different divisions and different less expert people will need to use it. And it needs to be, most importantly, quick to implement, because time is short and there's no time for complex, fully integrated sort of ERP type solutions. And finally, interfacing to existing systems. So there is, a need not to replace existing useful systems. There's a need to replace spreadsheets, but there's a need to interface with existing asset management systems at one end and ERP systems at the other end. So it needs to be very simple to implement and very easy to interface with existing systems.
Right, and what's the sort of the current state of the market out there at the moment then for these type of solutions?
Well, from an Innervision point of view, the market is really booming and getting more and more buoyant day by day almost. We're implementing a number of lease accounting, lowest lease accounting projects for several large companies at the moment, and we've got a very healthy sales pipeline. If we look back to beginning of 2016, when the announcements were made, there was a small spike in interest at that point, but in reality, we were much more interested in talking to our clients and prospects than they were in talking to us. In the first half of 2017, that changed a little bit, and we started to get a little bit more interest. The second half of 2017 has really gone. There's been a huge uptake in interest. We're constantly demoing our system now. We've We've done well over 300 demos in the past 6 months. We're responding to numerous RFPs, well over 30 in the past couple of months. Website traffic's trebled, which is a pretty good indication of the level of interest. And talking to our peers and the auditors, then there is a general there's a general realization that the market is really picking up, and there's an absolute expectation that 2018 is going to be even busier as more and more people scramble to sort of achieve the compliance by the deadline.
Yes, and sort of, I mean, just sort of thinking about that deadline again, I suppose. Really, what should people be? What should the ideal lease management accounting process look like come that deadline time?
Yeah, I mean, we've stressed throughout this discussion that time is short, and a simple and quick system implementation is an essential part of the project. But at its most basic level, IFRS 16 is just a compliance issue. There are opportunities to do things better, we think. We've talked about the efficiencies and the savings that you can potentially gain, but basically this is about compliance. There are really complex and time-consuming issues and elements of the project. Gathering the data, analysing that and assessing that is a really complex and time-consuming task. We don't think the system needs to be part of that complex task. We think the system element can be a really relatively straightforward part of the project. Certainly from the lowest lease accounting point of view, our system, we can get that implemented in days or weeks, certainly not months. So simplicity, ease of implementation in subscribing to a sort of cloud-based solution, we think is the way forward. And at a very simple level, what you need here is a sort of lease accounting subledger, something that takes data from spreadsheets, replaces spreadsheets, takes data from asset management systems and interfaces with them, and exports lease accounting reports and journal entries into your ERP. It's this is a complex project that's a bit more complicated than most people thought it was going to be. We're trying to keep the systems aspect as simple as we possibly can. Thanks, Chris.
Excellent. Thanks very much. We've got a couple of questions actually from listeners that have come into us. It's probably worth reiterating at this point actually that if you do have any questions or anything you'd like Martin or Maeve to elaborate on, or the things that we haven't covered yet, please get in touch and let us know. If we don't have time for the next couple of minutes, then at least there'll be someone at Innervision will get back to you with a direct answer to that. So the first one that's come in is are there any specific sectors that stand to be more affected by these changes than others? And if so, what are they?
Yeah, I mean, from my point of view, there are obvious sectors which are more affected than others, but the message, I think, is that just about every sector is affected by the changes. Anyone who has property and cars is affected by these changes. The ones that are particularly affected and where we're seeing a huge amount of interest and gaining a lot of success is in the retail space in particular, telecoms, transport and infrastructure. A lot of lorries and trucks are obviously leased, and obviously the airlines. So there are specific industry sectors where it has an acute impact, but basically every organisation is impacted by this change.
Yes, that's true. And it's another question that's come into us then is it sounds like a complicated process as we've been sort of elaborating here, but where is the best place to start, do you think?
From our point of view, I think the bit that takes all of the time and or a lot of the time and a lot of the effort is the data collection and assessing the leases. Trying to find out what exactly you've got, what shape that data is in, and which bits are missing. So I think that data collection phase and the validation phase is a hugely important starting point and can sort of start even without anything else. We also think that once you're going through that exercise of data collection, what you should also be doing is choosing a system, because having collected it all, you may as well put it onto the system you're going to be using, and then you can start to use that system to model the different options and make sure you're targeting the best one for your organisation. So I think those two elements, data collection and system selection, we would say are the high priority items at this late stage.
Right. Okay. We've got just a couple of. We've probably got time for a couple more quick ones. There's a couple of points of clarification actually, which I think it'd be good to pick up on. So someone has got in touch and said, I was under the impression that low-value leases had not actually been defined for UK purposes. Yeah. Yet we said earlier on that there was a £5,000 limit. Is this definitely correct?
I think it's $5,000, but Maeve, do you know if that's officially correct?
It's referred to in the ISB supporting information to the standard, and it is, if you attend any of the ISB conferences, they do tend to use $5,000 as that limit, but they do say it is not a bright light, so but they will always quote $5,000 as the value. So it is one of those things that most people work to $5,000, but internally within your organization, they know that you can set whatever that value is, but you have to be very careful about explaining why you think it is not material, whatever value you do come up with. This is something that really, from your financial advisor's perspective, you need to go and clarify with them, but certainly the ISB would quote $5,000, and it is generally referred to as the $5,000 limit.
Excellent, thank you. And another point of clarification is someone has got in touch to ask, what is the latest deadline for public sector organisations?
I don't believe there is a deadline being set yet. My understanding it was in 2021, but I'm not sure I've seen an official deadline for that. Maeve, I don't know if you've seen.
No, I haven't seen it, because I did try and find it, but I haven't seen it, so I'm sorry, I don't know.
We can try and investigate that a bit further and get back to whoever that was if they leave their name. But my understanding is that it's 2021, if there is a date at the moment officially announced.
Excellent. Okay, yes, just time for one more quickly then. Are there any anticipated changes in disclosure requirements with these new standards?
That's definitely one for you, Maeve.
Yes, there are quite a lot of additional disclosure notes. So you have to, from a quantitative rather than a qualitative, because there's quite a lot around the qualitative, you have to go through and actually, as you would with your normal finance leases today, you have to look at all leases and look at the liability and how the liability runs off into the future. You have to split that liability or the future rentals as well between the minimum lease rental periods, the interest and the PV. You have to look at the time buckets, the current and non-current splits. You've got to look at the right of use asset. You'd need that split by asset category, obviously, if you have to give further disclosure around your asset side of things. Your short-term and low-value leases, you have to actually say what the impact is on the balance sheet. So on your income statement, sorry, and separately identify as well the variable lease payments. You also have to disclose the future rentals to do with the short-term leases and how they're spread over the time buckets. So there's quite a lot in there, a lot more detail than you've had to give previously. This is where the existing operating lease note really wasn't as detailed at all, but there's an awful lot more detail you have to go into just from a pure quantitative perspective, not to mind a qualitative perspective.
Excellent, thanks very much. I think there are plenty of questions flying in actually, but I don't think that we're going to have time to get onto anymore. They're all very very complex actually, so I think that's probably a good time to wrap things up. As I said earlier on, Martin and Maeve and the team at Innervision have kindly agreed to answer any more questions via email, so they'll be getting onto the list we've got here. And if you have anything more that you would like them to elaborate on or answer any questions we didn't have time to cover today, please get in touch and let us know. Now, as you can see on the final slide there are some resources available to you for more information on this subject. Follow the link at on the sort of the bottom corner to innervision.co.uk, where you'll find plenty more reading on IFRS 16 and all that it entails. So all that remains to be said is to say thank you to both Martin and Maeve for your time today and for giving us a fascinating insight into what is a very, very complex subject. And thanks to all of you for listening, and please join us next time. Thank you very much. Goodbye.
Thank you. Thank you.
Thank you.